You're probably losing money without even realizing it. And the worst part? It's not because you're not investing. It's because you're making the wrong moves with your money. Most beginner real estate investors walk straight into traps that seem harmless at first. They think they're doing everything right, saving up, researching, watching YouTube videos. But when it comes to the actual deal, a single wrong assumption can cost them thousands. In this video, you're going to learn the most common mistakes rookie investors make in real estate. The exact ones that turn promising properties into financial burdens. And the best part? Once you understand them, you'll be ahead of 90% of beginners in the market. Stick around until the end, because I'll share a story about a rental property that looked like an easy win on paper, until I noticed one hidden number that nearly turned it into a disaster. Let's dive in. One of the biggest mistakes beginners make is buying with emotion instead of logic. They visit a property and get excited. This kitchen is stunning. Or the backyard is perfect for barbecues. But here's the harsh truth. You're not buying your dream home. You're buying an income stream. You're not looking for pretty. You're looking for profitable. A property might look like a magazine cover, but if the numbers don't work, it doesn't matter. You're not the one living there. The person renting it won't care about the style of the backsplash. They care about location, price, and whether the AC works. I've seen people buy properties that rent for $200 a month, but cost $150 to operate. That leaves them with a pathetic $50 in monthly cash flow before taxes. Add a plumbing leak, a vacancy, or a late payment, and suddenly you're in the red. That's not investing. That's gambling with better lighting. So how do you avoid this? Run the numbers before you ever set foot inside the property. Check the rent-to-price ratio. Look at comparable rents in the area. Project your cash flow with realistic assumptions. Maintenance, insurance, taxes, and yes, property management if you don't want to be on call 24/7. Another brutal mistake beginners make is underestimating expenses. They only calculate the mortgage. They forget about the silent killers, rising property taxes, annual insurance hikes, and long-term capital expenditures. New roof, $8,000. HVAC replacement, another $6,000? Water damage from an old pipe? That'll eat half your year's profit. You need to budget for the ugly stuff, not just the stuff you can see during a showing. Here's a smart rule of thumb. Set aside 10 to 15% of your rental income for repairs and maintenance. And keep a separate reserve fund for big-ticket items that might hit every 5-10 years. Also, plan for tenant turnover. Every time a tenant leaves, you lose rent. You might need to repaint, clean, or even fix walls and appliances. It's not just a gap in cash flow, it's a real cost you need to prepare for. Let me give you a real example. A friend of mine bought a duplex in a hot neighborhood. Great photos, great tenants, and a solid-looking cap rate of 8%. They thought they had hit the jackpot. But 6 months in, property taxes spiked by nearly 25%. Then came a major plumbing issue, $11,000 to replace the main sewer line. They hadn't budgeted for it. The cash flow vanished. They're still recovering. And the worst part? It was all avoidable with better due diligence. Coming up in part 2, I'll show you the subtle psychological trap that causes beginners to overpay even when they think they're getting a deal. And more importantly, how to protect yourself from falling into it. Let's talk about one of the most dangerous and costly traps in real estate, falling in love with the deal. It doesn't matter how many spreadsheets you filled out. When emotion creeps into your analysis, you're already in trouble. Here's how it usually happens. You find a property that's almost a good deal. The numbers are close, but not quite there. So what do? You start playing with the assumptions. You nudge the rent estimate up a little. You shave off 1% from the vacancy rate. You cut maintenance costs in half, just for now. Suddenly your deal looks amazing on paper. But you're not analyzing anymore. You're negotiating with reality. This is what's known as confirmation bias, one of the deadliest mistakes investors make. Instead of looking at the facts objectively, your brain starts trying to prove that your original gut feeling was right. And when that happens, logic goes out the window. I remember a duplex I almost bought in an up-and-coming area. The seller had already dropped the price twice. The photos looked incredible: fresh paint, new floors, even staged furniture. On paper, it was okay. Not great, but I wanted it to be great. So I convinced myself the area was appreciating fast. I assumed the rent would rise by 10% next year. I ignored the fact that 2 of the 4 nearby units had been vacant for months. Luckily, a mentor stepped in and asked me the brutal question: would this deal still make sense if you didn't raise the rent and had a tenant move out every year? I did the math, and it turned out I'd be underwater in year 2. That was a wake-up call. That's why you should always run the worst-case scenario, not just the best one. What if property taxes go up? What if rent stays flat? What if you have a non-paying tenant for 3 months? If the deal only works when everything goes right, it's a ticking time bomb. Another common mistake? Investing in a market you don't fully understand. It's tempting to chase high returns across the country. You see a YouTube video or a blog post that says, "Top 5 cities to invest in right now." And next thing you know, you're buying a property in a city you've never even visited. But here's what they don't tell you. That 12% cap rate might come with hidden problems, like high crime, weak job growth, poor school systems, or tenant laws that heavily favor renters over landlords. Real estate is hyper-local. 2 blocks can make the difference between a cash-flowing property and a lawsuit waiting to happen. Before you buy, you need to study the market like your money depends on it, because it does. Who are the major employers? What's the trend in property values? Is the population growing or shrinking? What kind of tenants live there, and what are they looking for? If you don't know the answers to those questions, you shouldn't invest there. And if you're buying out of state, build a trusted team on the ground. A local agent, property manager, contractor, and ideally another investor you can call when things go sideways. Because trust me, at some point things will go sideways. In part 3, we'll talk about the silent killer that drains time, energy, and money from thousands of new investors. Even when the numbers look great on paper, it's the one thing that can turn a solid property into a full-time job you never wanted. Let's talk about the silent killer of real estate investing. It's not taxes. It's not interest rates. It's not even bad tenants. It's underestimating the amount of time and energy it takes to manage a property, especially if you're trying to do everything yourself. When most beginners run the numbers on a deal, they calculate cash flow, cap rate, expenses. But they completely ignore one critical variable: their own time. And time is a cost. Every call from a tenant, every emergency repair, every late-night plumbing issue, that's time you're not spending with your family, on your job, or growing your next deal. At first, it feels manageable. You think, I'll just manage this one property myself to save money. That's exactly what I thought too. But here's what happened. My first rental was a small single-family home. It had a good tenant, decent cash flow, and everything looked fine for the first 6 months. Then the hot water heater broke. Then the tenant's toilet overflowed at midnight on a holiday weekend. Then came the request for a new fridge. Then she got a dog and scratched up the floors. I wasn't sleeping. I was juggling my day job and trying to be a landlord at night. And suddenly those $300 a month in cash flow didn't feel like passive income anymore. They felt like a second job that paid below minimum wage. What most beginners don't realize is that real estate is only passive if you build it that way. If you buy the wrong property, in the wrong area, with the wrong team, you're not building wealth. You're building stress. The solution? Run your numbers as if you're hiring professional property management from day one, even if you plan to self-manage at first. That's usually 8 to 10% of monthly rent, and it changes the math fast. And more importantly, don't buy a property that only works if you manage it yourself forever, because eventually you'll want to scale. And trust me, when you have 5 or 10 units, the last thing you want is to be fixing toilets on your weekends. Also consider tenant quality from day one. A lot of beginners are so desperate to get a renter in that they don't screen properly. They skip background checks, they ignore red flags, and they end up with tenants who don't pay on time, damage the unit, or worse, refuse to leave. Evictions are expensive, stressful, and time-consuming. They can wipe out an entire year of profits in a few months. It's better to have a unit sit vacant for 3 extra weeks than to place the wrong tenant in 3 days. Use a solid screening process. Check income, references, employment history, and credit if possible. Treat this like a business, not a favor. One more thing beginners overlook: local landlord-tenant laws. In some cities, it's incredibly difficult and expensive to remove a non-paying tenant. You might think you're buying a great cash-flowing deal. But if it takes 6 to 12 months to resolve an eviction, and you're still paying taxes and insurance the whole time, that's not cash flow. That's a cash leak. Learn your local laws before you invest. Understand what protections tenants have, how long evictions take, and what you're allowed to charge for deposits or fees. All of this is part of your real estate education. You can either learn it the easy way now, or the hard way later. Now, I'll show you how to avoid these mistakes from the beginning, with one simple framework that every successful investor uses. So far, we've covered the emotional traps, the financial blind spots, and the operational time sinks that catch most beginner investors by surprise. But now it's time to put it all together. Because the difference between struggling investors and successful ones often comes down to having a simple, repeatable framework. Here it is. Think like a risk manager, not a dreamer. Every property, every deal, every tenant. You should evaluate them not just based on what could go right, but what might go wrong. Ask yourself, what happens if rent prices stagnate for 3 years? What if maintenance costs spike unexpectedly? What if I lose my tenant and the unit sits vacant for 2 months? The investors who last in this game are the ones who plan for downside protection, not just upside potential. And that's the mistake most beginners make. They chase maximum return without thinking about resilience. Here's how to apply this. Whenever you analyze a deal, run 2 versions of the numbers. Your optimistic case and your realistic to conservative case. If the deal still makes sense under conservative assumptions, you're probably on solid ground. And don't just rely on online calculators or spreadsheet templates. Take time to build your own deal analyzer. One that forces you to include reserves, vacancy, property management, capital expenditures, and even tax increases. That alone will set you apart from 90% of beginners who are only looking at cash-on-cash return. Now let's talk mindset, because this part is critical. You don't need to get rich on your first deal. You just need to not lose money. If you buy a solid property that cash flows modestly in a stable area with low risk, that's a win. Even if you only make a few $100s a month, you're building equity, reducing debt, and letting appreciation do its thing over time. Real estate is a long game. It rewards patience, preparation, and discipline far more than flashy deals or big swings. Most of the investors who go broke, they weren't unlucky. They were impatient. So here's what I want you to remember. Don't rush into a deal just because you feel behind. Don't assume property value always goes up. And never, ever skip due diligence because you're afraid someone else might grab the deal first. There will always be another deal. But capital lost on a bad one takes time and energy to recover. Now, let's revisit that property I almost bought. Remember the one that looked perfect on paper? Beautiful renovation, great photos, promising neighborhood. The cash flow was thin, but I convinced myself the area would appreciate quickly. At the last minute, I double-checked something I had skipped before: the property tax history. Turns out the local municipality had reassessed values aggressively the year before. Property taxes were projected to rise by over 30% in the next cycle. That single change would have wiped out my entire margin. I walked away from the deal. And I'm so glad I did. Because the following year, that exact property went into foreclosure. That one detail saved me thousands and taught me a lesson I've never forgotten. Due diligence is what protects you when everything else goes wrong. So here's the summary. If you're just getting started in real estate, run your numbers conservatively. Budget for repairs, vacancies, and management, even if you DIY at first. Never fall in love with a deal. Know your market better than your competition. And build systems that allow you to scale without burning out. Because the sooner you invest wisely, the sooner you can build wealth that actually gives you freedom. Not just more work. If this helped you avoid even one beginner mistake, give it a like and subscribe for more videos like this. Let me know in the comments, what's your biggest fear about investing in real estate? Because if you don't start learning today, you'll be wishing you had 5 years from now.